Many people keep their savings sitting in a regular bank account, earning almost nothing. They believe that is just how savings work. They check the balance, see a slow tiny interest line each month, and accept it. But there is a quieter option that has existed for years, hiding in plain sight, earning meaningfully more without any extra risk. It is called a high-yield savings account, and ignoring it can quietly cost you hundreds. At its core, a high-yield savings account is simply a savings account that pays a noticeably higher interest rate than a typical traditional savings account. The money is still accessible. The structure is still familiar. The only real difference is that the account is paying you more for storing your money there. Most are offered by online banks with lower operating costs, which they pass on through higher interest rates. This matters because, over many years, the gap between a low-rate account and a high-rate account quietly becomes significant. A few percentage points difference may look small in a single month. Across many months, on a meaningful balance, it can be the difference between earning enough to cover a small bill each year and earning almost nothing. The same money, two completely different outcomes. The choice is yours. To understand how it really works, picture two banks holding the same $1,000 for 1 year. One pays a very small fraction of a percent. The other pays several times that. At the end of the year, the second account has more money simply because it offered a better rate. You did nothing extra. You took no extra risk. The structure of the account quietly did the work for you. Let us look at a simple example. Imagine $10,000 sitting in two different accounts. The traditional account pays a tiny percent and produces a small amount of interest in a year. The high-yield account pays multiple times that rate and produces several $100s in a year. The accounts are otherwise the same. You can access funds. You can transfer money. The only real difference is what the account pays you back. A common mistake is keeping all your money in one familiar account simply because that is where it has always been. Loyalty to a bank is not financial strategy. The bank does not reward your loyalty with better rates. It rewards the customers who actively shop around. Periodically reviewing your savings account rate is one of the simplest and most overlooked financial habits that can quietly improve your year-over-year financial life. There is also a hidden risk in chasing every flashy offer without due diligence. Some high-yield accounts come with conditions, minimum balance requirements, monthly transfer limits, or promotional rates that expire after a few months. The advertised rate may not be the real long-term rate. Reading the fine print before opening any new savings account protects you from being trapped in a structure that quietly underperforms after the introductory period. A useful way to picture a high-yield savings account is as the same room with better wallpaper. The room has the same furniture, the same security, and the same windows. But the wallpaper is friendlier, brighter, and quietly improves how the room feels. Both rooms hold your money safely. One simply rewards you slightly more for being there. The cost of moving rooms is small. The improvement, repeated month after month, is real. A second key idea is the role of online banks in high-yield accounts. Many traditional banks pay low rates partly because of higher physical operating costs. Online banks often have lower overhead and use the savings to offer better rates. They typically include the same basic safety protections through deposit insurance, depending on the country. The brand is different. The basic structure of your money's safety is usually quite similar. A practical example helps. Imagine someone moving their emergency fund from a traditional savings account to a reputable high-yield account. The fund is still accessible. It is still safe. It is still entirely separate from daily spending. The only change is that the same money now generates noticeably more interest in the background each year, quietly helping the fund grow slightly even when no new contributions are added. Beginners often misunderstand how high-yield accounts compare to investing. They are not the same thing. Investments can grow much faster over many years but also move up and down in the short term. High-yield savings remain stable and accessible. They are not designed to replace investing. They are designed to make sure that the money you must keep safe is at least keeping up with itself, instead of quietly stagnating year after year. There is also a psychology angle. Many people delay opening a high-yield account because they assume the difference is too small to bother with. The actual setup usually takes less than 30 minutes. Once it is done, the higher rate continues working in the background for years. The improvement is small per month but cumulative across time. Skipping such an easy improvement is one of the quiet costs of financial inertia. A simple practical rule helps you take advantage of high-yield savings well. Compare a few reputable options. Check the long-term rate, not just promotional rates. Confirm the safety protections that apply in your country. Make sure the account allows for the access you need. Move idle savings into the chosen account. Then leave it alone and let the higher rate quietly do its work for the long haul. There are things to avoid. Do not chase short-term promotional rates without reading what happens after they expire. Do not move emergency funds into accounts with unclear access rules. Do not split your savings across so many small accounts that the structure becomes unmanageable. Do not assume one bank's brand reputation is enough. Check the underlying safety protections. And do not move long-term retirement money into a simple savings account hoping for growth. A better habit is to review your savings setup once a year. Rates and offers change over time. The friendliest account today may not be the friendliest account in 3 years. A short annual review can keep your savings working as hard as they reasonably can. The review takes a tiny amount of time. The cumulative benefit, repeated for many years, can quietly improve the calmness and growth of your financial cushion. Over the long term, choosing the right home for your savings is not glamorous. It will not change your life overnight. But quietly, year after year, it improves the foundation of your financial life. Combined with steady contributions, regular check-ins, and sensible discipline, a strong savings account becomes one of the quietest engines of healthy long-term finances. The high-yield account is small. Its long-term contribution is real. So here is the short version. A high-yield savings account is a savings account that pays a meaningfully higher interest rate than a traditional one. It usually offers similar access and safety. Online banks often lead in offering these accounts. The math compounds quietly over time. It is not a substitute for investing, but it is a better home for the money you need to keep safe and accessible. If your savings have been sitting in the same low-rate account for years, consider taking a small action this week. Research a few reputable high-yield options. Read the rules. Open the right account. Move your savings. Then forget about it. The interest will arrive quietly each month. The improvement, repeated for many years, is one of the smallest and most underrated upgrades in personal finance you can ever make.